Well, Harmony Gold reported a loss in its third quarter earnings. This after a temporary closure of one of its mines slowed down its quarterly production by 15% to 247,000 ounces. Headline earnings per share fell to 47 cents. And joining us for a review of the results is CEO Briggs right now. Graham, thanks so much for joining us this afternoon.
Thank you very much for having me. Harmony's
numbers again putting in the spotlight the kind of pressure miners are operating in South Africa right now. How are you feeling sitting atop one of these operations but under all the pressure?
Yeah, as you know, it's an interesting job, but very rarely can you actually look at a company's figures and identify the cost of some events. And ours is dominated by Kusasalethu, both last quarter and this quarter. Mm-hmm. And if you look at the loss of production, 2.5 tons of gold lost. In all the events around, that's 1.2 billion rand. Put 1.2 billion rand back in the figures and Harmony's doing well, because all the other operations are doing reasonably well. Now March is typically a poorer quarter, and remember Kusasalethu was out for the whole of this quarter. So, you know, now we bring it into production. We did what we did. We bought, it's an asset that's worth bringing into production. It's certainly got a great future, but that's the cost, 1.2 billion rand. Mm-hmm. And that, of course, is assuming that it's on target for producing in the going forward. So it doesn't look at the quarter that we're in at the moment.
What about the quarter that's just gone, Graham? You're saying you're expecting a pretty poor March quarter, and it's almost as though from what you've just said that you think that this is more or less a once-off, Kusasalethu, for example, and everything is going to be getting back on track in the period that we're in right now. Is that the case?
Yeah, so Lindsay, I think, you know, when we say the March quarter, that's the March quarter we've just had, which is poorer quarter. This next quarter is much better. March quarter dominated by the seasonality, really the Christmas break, as well as looking at a bit of Easter as well, because those public holidays were towards the end of the quarter. So going forward, we're actually looking much better, and the planned production from Kusasalethu is about 50% of its normal production for the quarter coming up. There's about 50% of the tonnage coming out right now. It's difficult to estimate the gold, but about 90% of the labour is back in operation on Kusasalethu.
But we're looking at a very tumultuous labour environment as a whole here in South Africa. So, you know, where you're looking at a situation of production shortfalls as a result of labour unrest versus giving into demands now for double-digit wage increases this year, it really does put you in a catch-22 moving forward.
No, look, it's tough because, I mean, you can now see the cost of the labour issues at Kusasalethu at 1.2 billion rand for 6-month period, basically. And so, you know, going forward, you know, if you have strikes and those sort of things, you can see what it's going to cost, not only, you know.
What does that mean? An easier bending towards wage demands being put on the table?
No, I think, you know, the way that we're looking at wage demand, certainly in Harmony, is last time we structured a wage with a slightly lesser basic increase percentage and a bigger variable. So we've got profit share. So in other words, when the company does bad because of Kusasalethu, as an example, everyone suffers, including employees, because they get less profit share. But I mean, that's the way that we're looking at it, and probably that's the way a lot of other companies are looking at it and saying, you know, let's share in it so that if there's better productivity, if the gold price or the platinum price or whatever mining commodity you're in does better, then there'll be a sharing of some of the profits. So, you know, we're looking at incorporating our sort of structure of labour salaries back into looking at it as an investment. So getting labour closer to being a shareholder, if you like.
South Africa's one thing, Graham. What about Papua New Guinea? I mean, this is the great hope, and of course in the future it will hopefully live up to your expectations, but it seems to be underperforming at the moment. Can you tell us what's happening there?
Well, Hidden Valley is certainly underperforming. Wafi-Golpu has been going through a fantastic time. We've drilled, since the pre-feasibility study there, probably another 10 kilometres of core. And, you know, we've had better results, improved grades, better metal content, and also better test work on the metallurgical recovery. So that's looking good. And that's why we're now getting to the issue of looking at it as a phased and sort of scalable operation. So instead of going big bang, lots of capital to get it right up to production, rather to phase it in. In other words, it'll probably pay for a lot of its own capital going forward. So Wafig and Golpu are doing well. Hidden Valley has been underperforming. That crusher is busy going in as we speak. And so towards the end of June, it should be in full operation. That means we'll be able to use the overland conveyor and reduce a lot of the hauling costs. The hauling costs at the moment are probably something around about $100 an ounce. So that's an important cost to get out. But we are doing quite a few other changes there and basically looking at about 20% savings in total at Hidden Valley. I believe that Hidden Valley will be profitable during the next financial year.
While we're waiting, though, we've got CapEx spend seeing quite a bit of a shift. I mean, we've got the company now slashing capital, planned capital spending by almost a third, 1.4 billion rand being cut from your 2014 spending plans thus far. To what extent are operations in South Africa placing strains on, your balance sheet to invest in operations outside of South Africa's borders, or is this as a result of independent issues and problems?
No, I mean, a lot of the capital cost cut for next year is coming out of the Wafi-Golpu, looking at it scalable, so that's a big number. Hidden Valley, really it's a case of not expanding that, but getting it to the 4.2 million tonnes and keeping it there for a while. So that's going to reduce a bit of capex. 400 million comes from South Africa, and that's basically all sorts of bits and pieces all over the place, not one particular project. And then we are looking at reducing our corporates, services costs, supplier contracts and those sort of things, and we'll probably cut another 400 million out of that. So we're looking at some hefty reductions in cost going forward, and really it's looking back at the gold price. Remember, the gold price went down to just below 1,400, and we have to say we have to have a business that's profitable at 1,400, and that's what we're doing.
Graham, just final question, it's a personal question as well. I know a few gold miners, and you're tough chaps, and you're always quite optimistic, especially when it comes to the gold price, despite the fact it's come down from 1930 in 2011 down to its current level of 1475, was 1321 just around about 2 weeks ago. But every time you seem to take a step forward and you think, goodness me, I've got that out the way, something happened, the gold price falls 200, or there's another strike, or there's another fire. Do you ever think to yourself, I'm going to throw in the towel?
I guess, it's always an interesting discussion, Lindsay, but, it's an exciting job. Everything is different every day. It's a case of, when things are, it's dynamic. Everything is always happening all the time, and I guess that's what drives a lot of, not gold miners necessarily, but I mean mining people. That's what's exciting about the job. It's certainly not boring, you're right.